Everybody, I want to make a quick video on the Trading in the Zone by Mark Douglas book. Let's start with consistency. He talks a lot about being consistent, that somebody could win in the stock market with no prior experience. My mom could press a button and be a winner without needing to know. What's important in the stock market is, of course, being consistently winning. Doesn't mean always winning, means just overall you're profitable. He pretty much tells you to learn some edges, things that are more likely to happen than another. For example, if you're already familiar with breakouts or technical analysis gives you hints as to what's going to happen, may happen probabilistically. So a breakout, it's, if it breaks up, it's probably gonna go higher. It sometimes doesn't, it just fakes out, it just goes up and then goes back down, and then maybe it goes back up. But it's all about probabilities. How probable is a breakout? It all depends on your metrics and your variables, the time frame, and if you're scalping or day trading, swing trading, long-term investing, it depends. So consistency is the name of the game when it comes to stock trading. Something that kind of helps you gain consistency is accepting the uncertainty of each trade. So to get a win ratio or a winning percentage of like 60 or 80%, you gotta accept that you're gonna lose 40 to 20% of the time. So you gotta accept and believe that eventually you're gonna lose at some trades, and that's part of it. What you don't know is the order of wins and losses. It's gonna be random. You're gonna probably win, lose, win, lose, win. That's an 80%. I think so. Two losses wherever, they could go anywhere. The losses could go anywhere, but two of them, right? In 10 trades, so 50-50. Win, lose, win, lose, win, lose, win. Something like that. It's always gonna change. You don't know how it's gonna be arranged. It's just random and uncertain. But what is pretty much certain is the overall probability. After 20 trades, you're going to be pretty certain, if you stick to your variables and metrics, that the outcome's going to be an 80% win rate, depending on the edge, of course. So here I put that risk acceptance is the skill. Accepting your risk is part of just being like a robot. Like, if you trust your methodology, your edge, you're okay with losing like $50 to make 100, because overall, if your win percentage is 50%, you're still gonna be profitable, because you're gonna lose 50, win 100, lose 50, win 100. Overall, you're gonna be profitable. So basically, he points out that per trade, it's very uncertain and unpredictable. And in the overall, in a series of trades, after taking a series of trades, you can see that it's predictable that it's going to be like an 80%, 60%, whatever, depends on your edge, profitability or win rate. And remember, win rate is different from profitability, because you can profit $2 for each dollar. That's profitability. And win rate is just how often you win or how often you lose. All right, now let's look at, also don't take random, when you define an edge, don't include random variables that were not in there in the first place. First, go through your fixed variables, and then see that, and then if you want to change it, that's a different edge. It becomes a different edge. All right, next thing, something that's important when trading is that the reason you may be making a lot of mistakes is because in the past you have these beliefs that kind of change and define how you think about money. And so maybe you think having money is bad and only rich people are that money is filthy, that money is like a sign that you are somebody that's a bad person that just takes money away from people, then you're really not going to feel inclined to want to strive to get better and get the money. So there's going to be a conflict in you. So what you need to do is redirect the from energy from that belief onto the belief that money is good and you could do good things with money. A lot of people think money is bad. You gotta like really work for it. You gotta put in time to do it, to get it. But that's a belief, and beliefs have energy, and which is something Mark Douglas talks about. Beliefs have energy, and so you gotta take that energy, put it onto a belief that is gonna help you for your trading. And this book also applies to many things in all other aspects of life. Another thing he talks about is don't bother trying to know. It's a waste of time trying to know, because when you try to know, you're trying to convince yourself that this trade is gonna be the one that's correct and it's gonna make you money. And when you do that, you forget to put a stop loss. You forget to take consideration that that's not the case. Anything could happen and you can be wrong, and you will be wrong at some point. And when you are wrong, you're gonna feel hurt. You're gonna feel like the stock market did that to you, that it's hurting you, that it's attacking you. You're gonna feel betrayed, and you're just gonna lose control. You're gonna be emotional, and you're gonna make more mistakes. And with that emotion and those mistakes, they're gonna blind you from the opportunity that may happen right after that failed trade, which is like, hey, I know this trade didn't work, but hey, a couple minutes later, it does work, you know? So you gotta stay focused and understand that the losses are part of your edge, because the more you're losing, the closer you are likely to be for a win. All right. Expect a unique outcome. So don't have any expectations. Just follow the procedure. If you have an expectation, then that's gonna throw you off when you're wrong. And again, you're gonna have all these emotions. So be neutral for any outcome. Even if you do win, be neutral and be like, okay, I won, but eventually I'm gonna lose. So there's no point in me getting all excited, because I'm gonna give some to get some more, and it's just part of the process. And when you get excited, you might get euphoric and also lose control and be like, hey, I'm a professional, I know what I'm doing, and you risk too much your next trade. So this is important right here. Be rigid with your rules, and be flexible with your expectations. So keep your rules, like, hey, if I lose $50 for the day, I'm done for the day, and like wait for the next day. Like, hey, I'm only gonna risk $500 for the day, or I'm only gonna put in like 2 contracts or 3 contracts, and they're gonna cost this much. Like, they're gonna have to be this much volume, this much liquidity. The stock price has to be able to move this much, and all these parameters, metrics, variables, those are your rules. So those are rigid. You can't change them around. You got to stick to them. Your expectations are flexible, because you don't know what's going to happen. You just don't know. But overall, in a series of trades perspective, you should come out profitable based on your analysis, your study. So you test your edge. With real money or fake money, it depends how you want to do it. So why it's important to not get emotional with wins or losses is because when you lose, you're going to doubt your edge, you're going to doubt yourself, and you're only going to trade when you think you know, but you're never going to know what's going to happen next. Okay. So let the market tell you what's going to happen next through what you know about market movement, the nature of market movement. So that's reading price action and technical analysis. So you got to be focused, let the market tell you information. So you're collecting information, the way the price is moving, the way the chart is looking. It's going to tell you what's likely to happen, not what's going to happen. You can't be guessing ahead of time. Like, you got to take in all the information and you're going to get in the zone. So you're going to read the emotion. This is just like something you pick up through experience. You're focused and you just get this instinctual feeling that, hey, based on my technical analysis and also the way the volume is moving, the price action and my price targets, my stop losses, it looks like it's more likely to go that direction or this direction, whatever direction you determined. So let the market tell you, don't make up what's going to happen next. So all these understandings are going to take time and you got to keep practicing. So you got to be out in the lookout. You got to be on the lookout for your thought process. When you're in the trades, you got to snap out of an emotional state of mind and bring back to yourself to the zone. You got to think, hey, what am I thinking wrong? Am I being emotional? How can I shift back to being more objective and think back to how my edge works, so that you are focused on being aware of what you're supposed to be looking for when that edge appears, and you can take action on it, precise action. Also, consistency, back to consistency. Consistency is a state of mind, because you're always looking for the next opportunity that's in your edge, that your edge tells you should take. So you're always on the lookout with a positive winning attitude. So you have that attitude of looking and finding the trades that look more probable and look like your edge. And you can't let them go to waste. Don't be picking and choosing. You gotta, once you see it, you gotta execute it without emotion, but with confidence that your edge works. So you gotta test that your edge works. Now we're going to go to the parts that Mark Douglas highlights, and really these are pretty much the take home ones, the ones that hit the home run, and I'm going to read them. We all have 4 fears he talks about. These fears are the fear of missing out, the fear of loss, like losing money, the fear of being wrong, and the fear of letting a win turn into a loss. So those are the 4 fears that seep in your brain when you're not ready, when you don't have the confidence, when you are trading out of emotion and don't know what's going on, when you are just overly charged with negative energy and lack confidence completely. So those are the things you have to kind of eliminate. And the way you eliminate fear of missing out, for one, is you got to understand that there's endless opportunities. Hey, if you miss out, there's gonna be another opportunity. It's okay. Don't chase. That's what he's pretty much saying. If you're fear of losing money, understand that that's part of the business. Part of the business is accepting that you're not gonna win 100% of the time. That 40% that you win, and that 60%. That 40% you lose and that 60% you win on a 60-40 win percentage. You gotta accept it. Like, it's part of the process. Okay? And fear of being wrong, well, you can't expect to be right. It's just part of the game. Kind of goes back to the previous one. And fear of letting a win turn into a loser, Well, kind of take some money off the table. If you're seeing that it's making you money already, take some off and leave some for, like, let's see what happens. Okay. Here are the 5 fundamental truths of trading, which he talks about and he emphasizes a lot, which is pretty much one of the most important parts of the book. So you gotta understand this fundamental truth. This truth is, number 1, is anything can happen. Anything, literally anything can happen. I've seen things where it's like, what the heck just happened? When the stock market crashed in 2020, like, anything could happen. It could go up when you have expectations and just things happen completely opposite of what you expected. That's showing you anything can happen. So be ready and to accept that. You gotta accept also this other truth, number 2, that you don't need to know what is going to happen next to make money. So back to, like, my mom, if she presses the button, the buy button, she could be an automatic winner. So it doesn't take her knowing. She's like, so I don't even need to know. Nobody needs to know. The only thing I need to know is my probability, my edge. That's what I need to know. But I don't need to know what's gonna happen next in this precise moment, in this precise trade. I just know that overall, when I take 20 trades, 10 trades, 100 trades, I'm gonna win a certain percentage of the time. My win rate is gonna be a specific number. If I stick to my variables, all those things, my metrics. So that's number 3. Oh no, number 3 is there is a random distribution between wins and losses for any given set of variables that define an edge. All it's saying is it's disorganized how many times you win in the beginning, in the law, like out of 10 trades, like I said before, you win, you lose, win, lose, win. Like, it just varies. Like, you don't know the order of your wins and losses. That's all it is. You do not know the order of your wins and losses. It's just random. Okay? But overall, you should have, the same win rate for that specific edge. Number 4, an edge is nothing more than an indication of a higher probability of one thing happening over another. All right, it's like a lot of words, but all it means is an edge is just saying, hey, this is more likely to happen. This is more likely to happen. That's all it's saying. The edge is just telling you, hey, this is more likely to happen based on the technical analysis. This is more likely to happen. That's all it is. It's just defining edge, a higher probability. Okay? And number 5, every moment in the market is unique. That just, emphasizes that don't take each individual trade personally. Don't give that specific trade energy. Don't be like, oh, this gotta be. You just don't know. You just don't know. You gotta accept that you're gonna lose some money, and you gotta be willing to accept the money that you lose. Like, hey, I lost. Like, this trade is gonna cost me maybe $60 in this specific trade, and I'm okay with it. I'm willing to I'm willing to lose $60 for 10 trades. You gotta be willing to risk $60 each time. It's possible that your win rate, something happens and your variables don't work anymore, and something in the market has changed completely. Your edge is no longer effective, and you need to adjust. You need to adapt, and that's something that he talks about too. All right, now we're going to talk about the 7 principles of consistency. Number 1, to be consistent, you have to objectively identify your edge. So identify your edge objectively. Know the variables, the metrics, everything, and have it rigid. Number 2, predefine your risk at every trade. Remember, even though, like, let's say your win rate is 80%. Let's say you already won 8 out of 10. Does that mean you don't evaluate your risk for the last 2 trades? You still have to, even though it's 80 win rate and you already have the 80% win rate. You could win or you could lose. You could probably win, but if you don't put a stop loss or predefine your risk, you can give money away from the other trades. And you're gonna be like, hey, I already know I'm gonna win, or lose. Let's say you lose, and you're like, okay, these two are gonna be losers. Like, see and find out. Maybe it's gonna be a 90% winner. I don't know. Or let's say you lose twice already, 2 in a row, and you have an 80% win rate. That does not mean that the rest of the remaining 8 trades are gonna be all winners. It's not, it's probably likely, but anything can happen. And it just happens that just the stock market conditions have changed, and it's probably gonna be a 60% win rate. So 80% win rate is really high, especially if you're making a lot of money per trade. Except for scalping is common to get like 80%, 90% win rate for like real professionals, but they're quick and they use like programs that are really fast and direct to the stock exchange. All right, number 4, act on your edges without reservation or hesitation. Like, you have no choice to put on the trade, you just have to follow it. How else are you going to determine the win rate of that edge? Okay, you just got to follow the procedure. That's the only way to find out the win percentage and if it's worth trading that edge. Number 5, pay yourself as the market makes money available. So once you see it going in your favor, take some off the table and then leave the rest. He talks about how maybe divided your position to 4, like 4 contracts or 4 shares or 400, and you take like 2 off right when it's going in your direction, and then you take another quarter off like when it moves a certain amount, and then you leave the rest to see if it goes to the target that you set out that it will go to. Okay. Number 6, monitor your susceptibility for making errors. So that means constantly monitor yourself and be like, am I going beyond my rules? Am I bending my rules? So keep that in your mind and don't lose focus and think that you're already good. You don't have to like measure your risk. And last one, number 7, understand the absolute necessity of these principles of consistent success, and never violate them. So understand that all these principles are necessary. The 5 fundamental truths are also necessary. So this one's for consistency, the other ones were just truths. And then this next one is all the things you need to know. All the things you need to know. I mean, you need to know the principles, you need to know the fundamental truths, but when he narrows it down, he's like, basically all you need to know is that the odds are in your favor when it comes to your edge, a proven edge. You need to know how much is it going to cost you to find out if the trade is going to work. So know your stop loss. And you need to know, all you need to know is that you don't need to know what is going to happen next. So you don't need to know what is going to happen next to make money on that specific trade. So that's something to know, right? You need to know that you don't need to know what is going to happen next. And lastly, you need to know that anything can happen. Anything. All right? So touching back to like the fears, so here are some 4 tips to eliminating some of the fears. Don't expect the market to make you right, so therefore you shouldn't be afraid to be wrong. This is going to be regurgitation. You don't expect the market to continue in your favor, so there's no point in leaving money on the table. There's no, so the way I wrote it is like, I don't expect the market to continue in my favor, so I am not leaving money in the table. So if you take some off, like, hey, and you take all of it off, like, it's okay, like, you're not really missing out. All right, you already said like, hey, I'm gonna take money off at this line. Do it. If it keeps going, it's okay. There's more opportunities. Don't expect the market to give me. I don't expect the market to give me every opportunity. Therefore, I don't have FOMO, fear of missing out. Kind of relates to the other one. I don't expect the market to make me a winner, so I am not afraid to lose. Losing and being wrong, pretty much similar. When you're wrong, you tend to lose. Secret to the nature of trade. I mean, you could be wrong and still make money, because like it goes a little bit in your favor, you take some off, you notice that it's gonna really reverse, you take some off before you lose money. So the secret to the nature of trading at the very core of one's ability is, so the secret to the nature of trading. The secret to the nature of trading. Alright, he makes it all dramatic, but here's the secrets. The secrets is the ability, one's ability, you know, the secret is one's ability to trade without fear or overconfidence. Overconfidence is just as bad as fear. Number 2, to perceive what the market is offering from its perspective. You know, you need the ability to perceive what the market is offering from its perspective, not yours. What is the market telling you? What technicals is it showing you? Don't think like, have an assumption that, hey, today the market's gonna go up, I just feel it. Don't. Let the market tell you what is gonna happen today. And that's one I'm having the deepest problem with, because I'm like, today's an up day, today's a down day. No, I don't know. I gotta read the chart, and I have a very hard time struggling. I struggle really hard. I struggle focusing. Like, I really struggle focusing. I can get distracted. So I gotta stay on the computer and just focus. Alright? You know, you also need the ability to spontaneously enter the zone. The zone is a strong, virtual, unshakable belief in a certain outcome with an edge in your favor. It's a long one. It's a long one. So I believe, so I have the ability, you know, I should have the ability to enter into the zone. And the zone is just like focusing and taking in information. Taking in information. What do you know about technical analysis? Just everything just pouring. You're looking at the chart. You're reading. You're just in the zone, feeding off of what the market's telling you. Reading the market by the charts, the numbers, other charts, other technicals. It's all telling you something, and you know, at the same time you believe in an uncertain outcome. The market's telling you that this might happen, a certain thing might happen, but you also believe that that thing is gonna happen. You also believe it's uncertain. You don't know, but it's likely to happen. You know, because the edge is in your favor. The market is presenting you with an edge in your favor that's likely to happen, but it's uncertain. Accepting uncertainty helps you take the trade and not be mad that you lost, because anything can happen. And that's my summary of Trading in the Zone by Mark Douglas. A great book. I recommend that you read it in physical copy. I have my physical copy. It pretty much broke in half because we had it open for a long time, just reading like 40 pages at a time. Like, I tried doing that to like 40 pages at a time. I recommend 20 pages at a time. It's a great book. I've listened to the Audible version on YouTube, and that one's great too. But the best way to learn is the physical format, to take notes, to write down what you thought, like what you're experiencing, how it applies to your trading. So that's all for this video, which is almost 30 minutes. And I'll see you all in the next video. Subscribe to my channel. I post random stuff, but most of it is just helpful things. And so, you know, I'm just summarizing a book. These are not my advice. This is not my financial tips. This is just a summary of a book. Do not take my word for anything. All right, bye-bye.